The week started with mixed feelings. The US big technology stocks retreated yesterday, and the others gained a few hours before the much expected Nvidia earnings. Now, the US dollar rebounded as crude oil jumped to its 200-day moving average on rising geopolitical tensions in the Middle East, but also rising tensions within Libya. So, welcome. This is Swissquote's Daily Market Talk. So the week started with mixed feelings, the rising geopolitical tensions in the Middle East and between the West and China, and a pullback across the big technology stocks in the US cast a shadow on the optimism that the US Federal Reserve is about to start cutting its interest rates as soon as the September monetary policy meeting. So the S&P 500 and Nasdaq 100 retreated at yesterday's trading session, but the sell-off mostly hit the big technology stocks, as many stocks in the S&P 500 had a good day actually. So the S&P 500's equal weight index advanced to a record high level, and the Dow Jones Industrial Index actually hit a fresh all-time high level as well. But Nvidia fell more than 2% yesterday, just a few hours before its earnings announcement due Wednesday, while Round Hill's Magnificent 7 ETF retreated 1.34% at yesterday's trading session. Now, data-wise, the durable goods orders in the US jumped nearly 10% in the month of July, which actually looks huge, but that big jump that we saw was triggered by a rebound in aircraft orders, apparently, that plummeted the month before. And, well, this part of the index is very, very volatile from month to month. But anyway, that's also the reason why there is a separate data that, takes it out, and it's called the core data. So taking the transportation out of this number, well, the durable goods orders in the US stalled last month, and that number was actually in line with the actual market rhetoric of slowing US economic growth that, well, should eventually justify the beginning of the Federal Reserve's interest rate cuts in its September meeting. And, well, coming back to my indices story, the Fed rate cuts are, believed to provide a good and an ideal environment for a further rotation from the big technology company stocks toward the non-technology sectors of the market at a time when the earnings of the Magnificent 7 companies slow. Well, they actually slow to post a probably 34% growth last quarter. We'll have the exact number after the Nvidia earnings later this week, but that's from about a 40% growth recorded over the past year. While on the other hand, the earnings at the rest of the S&P 500 stocks rose by 6% last quarter from the negative territory. So, looking at these numbers, the fundamentals are actually supportive of a further convergence between the technology and the non-technology pockets of the market. But as you know, the problem with that is the technology is a major boost to the S&P 500 index, because Nvidia alone can move the S&P 500 index by around 1% in a single session. So if Nvidia poses its rally, well, there is little chance that we see the rest of the S&P 500 or the S&P 493 carry this index through the uncharted territories. Now, we will talk about the details of Nvidia earnings tomorrow, but Nvidia is expected to announce its second quarter earnings after the Wednesday's closing bell, in case you forgot that very important information for this week. But anyway, overall, investors were actually feeling a bit hungover at yesterday's trading session following a cheerful Friday session on dovish Federal Reserve rate cut bets. The US yields and the US dollar rebounded on Monday. The euro dollar retreated to 1.1150 level and settled a bit higher than that in Asia. Now, we don't have much for Europe on the economic calendar of today. other than the German GDP update, which actually came in slightly better than the expectations this morning on a yearly basis, but still very soft for what we used to see for Germany. I mean, the growth was just 0% instead of negative. Across the channel, cable consolidates a touch below the 1.32 level this morning. Across the globe, the dollar yen trades just near a little bit lower than the 145 level, though the Bank of Japan's core CPI figure came in softer than expected by analysts this morning and showed that inflation in Japan, as calculated by this core BOJ index, unexpectedly fell from 2.1 to 1.8%, a data point that could tame the Bank of Japan hawks, but will certainly not reverse the rising appetite for the Japanese yen, as the Bank of Japan seems to be holding its ground these days for further normalization for their policies. In Canada, the dollar CAD sank below the 135 level for the very first time since April, and it was helped by a rally in crude oil prices due to rising tensions in the Middle East. On top of that, the news that Libya's eastern government, which is internationally not recognized, said that it's shutting down oil fields in response to attacks on the leadership and employees of the Central Bank of Libya. Now, you have to know that the eastern government of Libya produces around 1 million barrels per day, which is a substantial portion of Libya's overall oil production. So, US crude was up by 3% at yesterday's trading session on all of these news, and around 8% in the past 3 sessions. The price of a barrel is testing its 200-day moving average to the upside right now, where it sees some strong resistance. Now, the $78 to $80 per barrel range is full of offers, mind you, that could be cleared with the mounting tensions of all sorts at the moment. Yet the slowing global growth worries will likely keep the upside potential limited above this range of trading in the medium run. Over in China, the market sell-off continues. The CSI 300 index trades at the lowest level since February this year. The latest bad news came from Canada actually this week, which announced to impose tariffs of 100% on Chinese-made electric vehicles and 25% on steel and aluminum to protect its domestic manufacturers. Now, the mining company BHP CEO actually warned of higher volatility in global commodity prices in global commodity markets due to these Chinese woes that won't go away, and said that the iron ore supply will outpace demand into next year as surplus steel floods the market. So iron ore futures are actually struggling near their pandemic low levels right now. Other than that, still in this context of mounting geopolitical shenanigans between the West and China, IBM said that it will shut its R&D department in China. It's also due to the mounting tensions, as I said, between Beijing and Washington. And if all this is not enough bad news for you, the Chinese e-commerce giant PDD, Pinduoduo, the owner of Temu, plunged nearly 30% Nasdaq yesterday and just hence recorded its biggest one-day loss ever after the company warned of slowing sales as the competitors like Alibaba, for example, also increased their efforts to attract budget-aware customers. Now, zooming out, CraneShares CSI China Internet ETF posted its worst weekly outflow in 2 years as investors moved their money into the EM bonds on Federal Reserve rate cut bets. As such, JP Morgan's US dollar denominated EM bond ETF rose to the highest levels this year and has actually room for further rally, as the ETF currently trades with about 23% discount compared to its pre-pandemic times levels. Now, speaking of the pandemic times, the rising Mpox cases beyond Africa actually boost appetite for vaccine makers' stocks these days. Among them, we have the Danish Bavarian Nordic. We also have Emergent Biosolutions, Virax Biolabs, and GeoVax Labs. So in case you want to dive back into the pandemic time games and bets, you can bet that these companies will probably record a temporary jump in their stock prices due to a temporary jump in their profits due to the health emergency before eventually falling back on earth probably. So this is all for today. I'm İpek Özkardeşkaya today, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.